Hey traders, Akil Stokes here and welcome to another episode of the Trading Blog. In today's episode, I want to share with you some footage from my live trading room and a conversation we had about creating a trading portfolio and how many pairs should you be trading. So sit back and enjoy. And of course, if you're ever interested in joining me in a live trading room, so trading 3 hours a day with myself and our wonderful community of traders, feel free by heading over to www.tradeempowered.com and go ahead and sign up for a free 1-week trial. Look forward to seeing you guys in there, and I hope you enjoyed today's footage. Oh, wrong chart. Sorry. It's going to take a long time. Long chart. Rob says, how do you decide what pairs to trade? You decide that after you go through your back testing process. The easiest thing I can tell you is you want to trade the pairs that perform well with your strategy. Now, when you get a little bit more detailed, you may want to take correlations into account, not being over leveraged, but not being overexposed with certain pairs. But in the beginning, you create a portfolio based on the size of pairs or number of pairs that you want to trade, and it should be ones that work well with your trading strategy. You don't want to trade pairs just to trade pairs. Believe it or not, I had a trader do that before. I had a trader that was like, he was trading the euro dollar, but it didn't work well with his trading strategy. But because the euro dollar was so popular, he felt like he needed to trade it. And I was like, no, don't just trade it just because. If it doesn't make any money for you, right? Why are you wasting your time? Just check to see. I think it's going to be invalid on the 15. We'll go to a 15-minute chart. Let me double check here. Yep. All right, so I can't. No, wait a minute. Yep. Okay. All right, let's head over to. Let me get these questions real quick. Think about it like this: if the pairs that you trade are like kids, like children, right? And you're running a daycare, right? And it's just you watching all these children. How easy is it to watch one kid? Right? Not too hard, right? Watch one kid, make sure they're not spilling stuff, make sure they're not breaking themselves, right? Stuff that kids do, right? You think it's easier or harder to watch two kids? Probably a little bit harder to watch two kids, but still doable. 3 kids, still doable, a little bit harder. 4 kids, a little bit harder, right? But you see, the more kids you have, right? So let's say you start going up to 15 kids. Well, now it's probably going to be a little bit more difficult to give all of those kids the same attention, right? And then every once in a while, one of those kids is going to slip through the cracks, right? One of those kids is going to be on top of a table playing with a knife, but you may not see it because you're watching the 10 other kids. Same thing with trading. The bigger portfolio you have, the more it splits your attention. The more it splits your attention, the more trading opportunities you miss. The more trading opportunities you miss, the less consistent you are. The less consistent you are, the worse your trading results are. So that's the one thing. The other side is just overexposure. Now, I would assume if a trader is trading a very large portfolio, they have adjusted their money management accordingly. But if there's one thing I've learned with working with traders and seeing the type of traders I see with on a daily basis, is that you don't want to assume that they have any knowledge of doing anything. So you'll see a trader that says, "Hey, Keel, I trade a 2 mini lot standard position size on my 4-pair portfolio." And then the next time you talk to him, "Hey, Akil, I've just upped my portfolio to 12 pairs, so I tripled the size of my portfolio." Well, what's your position size? Well, I'm still trading a two mini lot standard position size. You guys see the trouble with that? What is that trader now risking? We did get a higher high, higher close on dollar yen, so that's most likely going to stop our trade out. So we're looking at a loss here. Doesn't mean it's going to happen, but based off reading price actions, it's probably going to be a losing trade here. But yeah, you leave yourself at the risk of overexposure. Because now you're trading 13 pairs or 12 pairs. There's a possibility of your losing streaks being bigger. There's a possibility of you being involved in more trades at once. There's a possibility of you taking a much bigger drawdown than what you're used to or maybe what your account can handle. My greatest war story about losing $30,000 was because I had about 6 trades on at the same time. And all 6 of them lost at the same time. So it was just a massive hit at once. So there's pros and cons. You know, a lot of people think that the more the merrier, the more pairs you watch, the more opportunities you'll find, which is true. There are going to technically be more opportunities, but you're also going to miss more opportunities. You're not going to be as focused on the good opportunities. So if there's one thing I've learned in my trading career, I used to trade like a 20 pair portfolio. I used to be a monster. All of the pairs. What's your portfolio, Akil? All of them. What pairs do you trade? All of the pairs? Yep, that one too on the side. Once I slimmed down my portfolio size, really 12 is kind of my limit that I would go to. Once I got under 12, and even that's a lot, I'd probably prefer to be around 8. But once I get under 12, I saw a massive difference in my trading. And what I mean by that is just a massive, it wasn't, my trading didn't get better, but I was just more focused on finding better opportunities. I didn't miss as many opportunities. So, good question. Yeah. And once you, I mean, a lot of these pairs, you know, you guys know how I feel about correlation, but a lot of these pairs, once you get out of the majors, there's probably like 8 major pairs, right? Or major, semi-major pairs. Once you get out of these pairs, and once you start going to stuff like New Zealand yen, Canada yen, Aussie yen, they're basically the same pair. Australia had some good news yesterday. You see how you're looking at basically the same pair here, guys? Zooming in some. This is basically the same pair. Obviously, there are slight differences, but you're looking at the same pair. So once you get out of those strong 8, you know, I say if you're going to make a portfolio, I mean, choose one of these. Choose your favorite one, right? If you got backtesting results on all 3 of them or all 4 of them, right? Choose your favorite one, because essentially you're just trading the same pair if you're going to trade all 4 of them. And again, you leave yourself at risk of just being very, very overexposed in the market. Now, when things go good, they go really good. The part of the story that, you know, when I lost the $30,000 worth of money, right? Because I was trading, you know, about 4 of those pairs were correlated. And a week later, right, after I quit trading, quit trading for a week and restarted, a week later, all 4 of those trades had winning trades, and I would have made $60,000 back. So when the wins are when they all win, it's good. When they all lose, it's bad. But as a professional trader, do you think we want those type of swings, violent swings in our equity curve? All right, traders. So I hope you enjoyed today's video. And if you did, please show us by hitting that like button and subscribing by clicking the button right below. If you're looking for more educational content, feel free to head over to our tradeempowered.com website, or also take a look and you'll see more videos available for you. Have a good one.